Hello and welcome to the Capital News. I am your host, Alex Kreitis. Thanks for joining me today, everyone. Hope you're all doing well out there. Let me get into the economic news of the day by starting with the stock market. The S&P closed down 7 points. The Dow closed down 104 points. The Nasdaq inched up 6.5 points, and the Russell 2000, the small cap index, was up 2 points. Now, we did see some whipsawing back and forth in these markets. The Dow was actually down, I believe, 200 plus points at its lowest point during the day. It did, of course, rally because, you guessed it, more China trade talks with the U.S. We had Larry Kudlow, the White House chief economic advisor to the president, come out and say he felt good vibes. He felt some good vibes that we're getting closer, that we're going to make a deal. So I don't know what that means. It's what we've been told from day one, basically, that there's been good vibes or something nice and positive happening, but still no ink on any paper, no deal, no meeting of President Xi and President Trump, although that's supposed to happen soon. Although maybe it's not going to happen soon because we were just told yesterday that there may be a 60-day extension to the trade talks. So the deadline was not really dead. It was sort of, he was just laying there. He was in a hospital bed. He wasn't dead yet, but he was there. So we don't know if that will be extended. We don't know what these good vibes are going to turn into. Could be a deal, could be nothing. But the markets did rally a little bit from their depths. The S&P was pretty much in the red all day. The Dow was pretty much in the red all day. Nasdaq was up and down, as was the Russell 2000. But once you see when Larry Kudlow came out, you see where it was at the bottom, and then it started to rally towards the end of market close. Oil, gold, and silver, same thing. There was some small movements, some swings throughout the day. But come market close, there was really no difference from the previous trading day. Although we did see a nice difference, a 2% difference actually, in the 10-year yield, given the sell-off, the minor sell-off in stocks, we did see a flight to safety, I guess, in Uncle Sam. And so now the 10-year yield stands at 2.66%, down nearly 2% for the day. So why the market sell-off? Is this just a technical pullback? Was there some news in the markets? Yes, there was. There was some news in the markets, actually. We got retail sales, and they were not as strong as we expected. Remember, we were told during the holiday shopping season last year, Thanksgiving, Christmas, this was going to be a trailblazer of a year. The consumer's back, baby. He's back. He's got more money in his check because of the Trump tax cuts. Oil was in a bear market. The gas prices came down. Jobs are up. Wages are up. Everybody's feeling happy. Merry Christmas to all. But now we got a conflicting report. So now we don't know what to believe once again. But here's an article from MarketWatch detailing some of this, and let me read a few paragraphs of this for you. The numbers. Sales at retailers fizzled in December and posted the biggest decline in 9 years, in a worrisome sign for the U.S. economy, according to a long-delayed government report. And of course, that was delayed because of the partial government shutdown, where we will continue to see more and more data make its way to some sunshine here over the next few weeks. Retail sales sank 1.2% in December, the U.S. Census Bureau said on Thursday. It's the largest drop since September 2009, a few months after the end of the Great Recession. Economists polled by MarketWatch expected sales to be flat. The disappointing drop in sales battered stocks in Thursday's trades, but many economists were skeptical that sales were quite the disaster the report seemed to indicate. What happened? Retailers faced plenty of headwinds in December, including a stock market meltdown, sudden talk of recession, the start of the partial government shutdown, and a bout of unusually poor weather. Yet the large decline in sales appears to go beyond that and offers more proof the economy slowed toward the end of 2008. Sales fell in every retail category except auto dealers and home centers. Sales fell the steepest 5.1% at gas stations, but that was not unexpected. Gasoline prices have been falling since last fall. What's surprising was a 3.9% reported decline in sales at internet sellers. That would mark the sharpest drop since November 2008, the middle of the last recession. Yet by all industry accounts, online merchants led by Amazon and eBay reaped big sales gains. Less surprisingly, sales tumbled 3.3% at department stores that have been losing ground for years to mainly internet-based competitors. Traditional brick-and-mortar chains such as Macy's, Kohl's, and Nordstrom posted disappointing sales in December. Sales also fell at bars, restaurants, apparel stores, grocers, home furnishers, pharmacies, and outlets that sell hobby items such as books and sporting goods. Sales rose 1% at auto dealers, while home center sales edged up 0.3%. It goes on. The big picture. The sales slump in December will weigh down the government's official scorecard for the economy known as gross domestic product. Economists have estimated GDP would slow to 2.7% in the final 3 months of the year, but now that estimate is being taken down even further. What does it mean for the economy in 2019? Hard to say. Anybody's guess. The stock market tanked in December, and talk of recession briefly became all the rage, and that may have hurt sales. Yet the stock market rebounded in January. Consumer confidence remains high, and companies continue to hire at a strong clip. The economy should avoid a recession as long as the labor market remains healthy, but growth in 2019 is unlikely to match the strong performance of 2018. So there's also a quote here from an economist. It's a puzzle. Strong job gains, wage growth, and the drop in gasoline sales should be very supportive of consumer spending growth. I'm not going to mention a name, but are you kidding me? It's a puzzle. What are you looking at? Maybe you should listen to this show and hear that the consumer is not as strong as politicians lead you to believe. Maybe you should have read the report from the New York Federal Reserve that stated that 7 million Americans are 90 days plus past due on their auto loans. That is not the sign of a healthy consumer. A healthy consumer is not one who pulls out credit card after credit card and says, charge it. Pick a card, any card. Strong consumers don't have debt. Period. Now, we live in the land of Oz, and everybody thinks otherwise. The more debt the consumer has, well, obviously, he's buying stuff, and he's doing so because he can't afford it. No. He's putting it on credit cards because he can't afford it. Everything's commercial. We shouldn't be putting our friends and loved ones into debt to make us happy for a few hours for a gift on Christmas Day. Maybe we should be more happy just to be in each other's company if it's going to put somebody in a tough financial position. But then GDP would get hurt, and then what? Ooh. Then it's a recession, then we're all in trouble. Stop buying crap you don't need, you don't use, and you can't afford. Take care of yourself. Take care of your financial well-being. You have student debts? Pay them off. You have auto loans? Pay them off. You can't afford the nicer, fancier car? Don't get it. Don't get it. Get your financial self in check. Get some other debts paid off. Start earning a nice income. Start saving it up. Then if you want to go spoil yourself with a fancier car or some other luxury item, go do it. You're allowed to spoil yourself. But don't put yourself in trouble with all of this debt. And then don't be blind to see, if you're some sort of analyst or think you're an analyst, to think that more debt means a strong consumer. It doesn't. You should see the numbers on debt, student debt, credit card debt, auto loan debt, mortgage debt, corporate debt. It's all at all-time highs or nearing all-time highs, depending on the metric. So what's the truth here in this retail report? To be honest with you, I have no idea. Of course, I'm a little bit more biased to the downside overall, so I tend to want to believe this report. But then you have all of these other reports that came out in the fourth quarter saying that sales were terrific. So which is it? You have all of these private companies coming out with their surveys, with their analysis, saying everything's great, it's going to be a tremendous Christmas. And now you have the government come out following this shutdown with a report that said it was lousy. Now, given the other string of data that came out that I just referenced, the 90 days plus past due on auto loans, which is a record, by the way, outstripping that of the Great Recession, I'm more inclined to believe this report because now it's at least trending in the same direction. Will it continue? We'll have to wait to see some other numbers. Now, one of the interesting things that was mentioned in the article was this report may have some economists start to reduce their Q4 GDP numbers. So it'll be interesting to see if we get some market manipulation here. And what do I mean by that? Well, if you say you were expecting 2.4%, 2.5%, for example, and because of some other bad news, such as this report comes out, now you say, well, maybe it's only going to be 2%. Okay, so you trim a half percentage off. 2.5% to 2% now. Well, what happens if the market comes in at 2.3% or 2.4%? Is that going to be a surprise to the upside and now markets are going to rally? I mean, that's how it works, and I'm going to give you an example here shortly of what's going on in these markets. It just is another example of the disconnect and the craziness that is taking place. Now, it's somewhat par for the course and has been for a while, but let me give you that example now. And this has to do with Nvidia, which reported their earnings after hours today on 2/14/2019. And happy Valentine's Day to everybody out there. And if you don't like it, that's fine too. But Nvidia, this was, and I think it still remains, sort of a darling of Wall Street. They love this stock. It's like a Netflix stock. It just, whatever happens, just has to keep going up. Tesla, it doesn't matter what the fundamentals say. It doesn't matter about anything. Wall Street just wants to keep bidding this thing up, 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 and away. Revenue sinks 24%, but Wall Street feared worse. So after hours trading, it's up 5%. Now, it could be a short squeeze. I don't know, but it's trading up at 5%. We'll have to see what happens tomorrow on Friday's trading day to see if this carries upwards or if it's just some sort of short squeeze. Now, Nvidia was trading at $280 per share in September. It now stands at $162, and that's including the 5% after hours. So that's a decline of more than 40% in a 6-month period. Not too good. Nvidia is a chip maker. They specialize in chips that are for gamers out there in video games. They have some really good graphics. They do other chips in addition to games, but that's their forte. And one of their biggest customers, and a lot of their business is generated in China. And they came out in the fourth quarter and cut their forecast from $2.7 billion, which is what they were initially expecting, down to $2.2 billion. Okay, so we went from 2.7, they downgraded their own numbers, their own projections to 2.2 billion. Okay, per their report in after hours trading, they said revenue of 2.21 billion versus 2.2 billion estimate that Wall Street came out with. So they beat it by $10 million. Earnings per share were 80 cents versus estimates of 78 cents per share. So Nvidia beat expectations on revenue and earnings after a downgrade. You get what I'm saying here? Revenue sinks 24%, but Wall Street feared worse, and so now we're up 5%. I can't make this stuff up. I can't make this stuff up. This would be akin to saying your boss gave you a deadline. Bob, I need this report on my desk Monday, end of day at the latest. Bob doesn't get it done. He tells his boss, he said, look, just not going to happen. But I'll get it to you first thing Tuesday morning. You know you can count on me. Well, Bob doesn't give it to him first thing Tuesday morning. He gives it to him by the end of the day on Tuesday. But his boss gives him a raise. Maybe even a promotion. And he says, hell, I wasn't expecting this thing until Thursday. That's what we're dealing with. Now, if that experience has ever happened to anybody out there, please write in. Please leave me a comment. You don't even have to tell me your name, but I want this story. Because that would be entertaining. If you got a raise or a promotion because you weren't as bad as what they thought you were. But that's the type of market that we are living in right now, and there's no end in sight. Again, it could be a short squeeze, or it could just be that Nvidia is a darling of Wall Street, and anything that looks quasi-positive for the biggest BS artists out there to make it spin and look positive and shiny, man, that's good enough for me. Yeah, that's fine. That's not good enough for me. It shouldn't be good enough for you, but that's where we live. Now, some other news on the U.S. retail side of things. We have Payless Shoe Source entering bankruptcy. And they will be closing all 2,300 stores. Again, that's 2,300 stores. Payless Shoe Source is entering bankruptcy. That is not good, ladies and gentlemen, for the retail side of things, and really just goes to validate the report out of the Census Bureau. Now, it is possible that the company finds an 11th hour buyer, but I would have to say that's probably unlikely at this time. So those stores will be completely shuttered, those jobs will be lost, and all of that real estate will be empty. So I don't know if all of these retailers who are starting to close more and more stores, going bankrupt, I mean, the list continues on and on and on, what this is going to do to commercial real estate prices. Can't be good, because you got a lot of empty space. So is this just the start? Is this the thawing of more things to come, or is this just going to be a patch that we get over? Time will tell, but it's my job to stay on top of it and keep you informed, and I will. Now, in yesterday's podcast, I went over some topics that related to Deutsche Bank and their list of 30 market risks for 2019, and we got through 6 of them yesterday. We'll see how many we can get through here today, but I'm not going to overload you with information overload by any means. It's a lot to discuss and go through, but they're all relevant to some degree or another. So point number 7, higher hedging costs continue to lower European and Japanese appetite for U.S. credit. So here, what Deutsche Bank is pretty much referencing is the fact that the risk-return trade-off for European and Japanese companies or individuals to get involved in the U.S. credit markets may continue to diminish. And obviously that was one of the things that was taking place during the final quarters of 2018. And just as a refresher, this list was created by Deutsche Bank in late 2018. So some things on this list pertain to that time period, obviously. Point number 8, ECB, the European Central Bank, quantitative easing, or QE, is ending, means less global demand for fixed income. Now, if you've listened to this podcast, you know that talk is cheap, especially from central bankers. We've had our Federal Reserve say that they were going to be hawkish, that we were going to go from QE to QT, quantitative tightening, and that we would continue to increase interest rates. Well, we know that we've done a 180 on that. So while the ECB may have come out and stated that they are going to be ending their quantitative easing program, don't be so certain. Don't be so surprised if the ECB does a 180 as well, especially after Italy has formally entered a recession and Germany has just, by the skin of its teeth, dodged a technical recession. And this list obviously refers to global demand for fixed income. So what does that mean? If there's less demand for fixed income, that means yields are going to rise. So any new debt that is going to be issued by these respective governments is going to increase. And I've told you time and time again how much the U.S. spends on interest payments alone, which is why it would be devastating if interest rates tick up even a hair. It's not the problem, ladies and gentlemen, that the central banks around the world are starting to tighten or maybe in talks of tightening. It's the fact that they left interest rates too low for too long. That's the problem. Everybody wants to blame what they're doing now, and at least from a communication standpoint, in the fourth quarter of 2018, and even prior, that there was going to be more quantitative tightening. There was going to be increase to interest rates. And that's what people want to demonize, that they're increasing interest rates. That's the wrong thing to demonize. The problem was too low of interest rates for too long a period. Now there's almost no cure for the patient. We may very well be a zombie economy. We may be turning into Japan. Which leads me to point number 9. Bank of Japan quantitative easing slowing means less global demand for fixed income. Well, we already know that the Bank of Japan will do anything at all and any cost to avoid any type of downward deflationary pressures, which means that they're going to have to turn on their printing presses, which they are very happy to do. They've been doing it for 20-some years, and there's no end in sight. Now, they can talk all they want, again, how they may want to slow something down, but talk is cheap. What are they actually going to do? If China continues to slow down, do you think Bank of Japan is just going to say, okay, let's start tightening? When the second largest economy right next door to us is slowing down? Point number 10. U.S. 2 and 10 yields. That's referring to the treasuries. 2-year note and 10-year. Curve inversion has negative impact on confidence in credit and equities. Okay, this is commonly referred to as the yield curve. Why is this important? It's important because the yield curve, which is the difference between the 2-year and the 10-year U.S. Treasury, tends to be a relatively stable and accurate predictor of recessions. If this yield curve inverts, meaning it enters a negative territory, then the likelihood of a recession in the near term increases. I've actually studied this for school. It's actually pretty interesting to look into, and I suggest that everybody does. There's a lot of information. Again, I tell you time and time again that the bond market is the adult in the room, and they sort of have a better pulse on what's going on, not only in the U.S. market, but in the global economy. So that's why yield curves, and you can do this against any 2 treasuries you want. But typically, and when you do studies and all that type of jazz, the 2 and the 10 is the most predictive of an oncoming recession. Now, it doesn't mean that it's imminent. It doesn't mean that it's going to happen next quarter. It doesn't mean that it's necessarily going to happen 6 months from now. It could be a year from now. But it's something to watch, and if it inverts and goes negative, then it's definitely something I will discuss further here, and keep your eye on it. And with all the manipulation that's taking place in the bond market, with central bank buying and selling, this thing could invert, it could widen, it could go any which way. We'll just see if the markets have a say-so in what happens, or if it's going to be continually, artificially moved in one direction or another by the Federal Reserve and other central banks around the world. Point number 11. U.S. corporate tax cuts continue to boost share buybacks, but not capital expenditures. Well, we know this is pretty much the case. We have so much uncertainty in the global economy with regards to the U.S.-China trade talks. There's still no more further clarity with talks regarding Brexit. We know Italy's in a recession. We know Germany just dodged one. We know France has the Yellow Vest protests, which are continuing. We know China is in a slowdown. We know the numbers aren't great in Japan. We're continuing to see downward pressure on pricing in Australia. The same thing will be happening in Canada, mark my words. So what in that picture is going to make all of these U.S. companies start to invest more and more money into capital expenditures? Building more plants, buying more equipment, investing in more software. Especially the major projects, when there's so much uncertainty for the demand thereof. Now, the buybacks, those are going to continue until they can't. So they're going to take that money. I've had this discussion with you guys many times before, and we'll continue to do so, because I honestly believe that the share buyback chickens will come home to roost. Because a lot of this is being done on cheap money, or now with some of these tax cuts. So this allows these companies to increase their earnings artificially by buying back their own stock. Which leads me to another question. How much of this stock market rally, not only the one from January on, but over these past 10 years, has really been driven by cheap money, which has fueled share buybacks? I'd have to say quite a bit. So it hasn't been organic growth. So if companies can't continue on those types of rates of growth, what's the market going to do? If earnings are the mother's milk of stock prices, and you have lower and lower earnings, where do you think we're going, ladies and gentlemen? I could be wrong. Maybe we continue higher. Again, I don't get into the day-to-day trading. It's not my thing. I'm not smart enough. To me, that's a fool's errand. Don't get involved with it. But from the longer-term perspective of a couple few years, I definitely see us moving in a negative direction, and it could be quite violent. Point number 12, and we'll stop for the day. The impact of potential U.S. government shutdown on markets. Again, this list was done near the end of 2018, so that it wasn't certain at the time of whether or not there would be a partial U.S. government shutdown, which of course there was for 30 days plus, which was the longest in U.S. history. What's that going to do to the overall market? Not much. Not much, to be honest with you. Obviously, those who were personally affected, it affected their checkbook for a couple paydays, for a couple paychecks. But overall, it's more akin to something like a natural disaster, a hurricane, a forest fire, something like that. It'll show up, it'll be a blip on the GDP numbers. So anybody who wants to use it as an excuse for some weaker numbers, that's all it is. It's an excuse. It'll just be a temporary blip. But I will end it there. That's point number 12. We will pick this up at another time. Thanks for listening, everybody. Glad to have you. Please continue to check me out on YouTube, thecapitalnews.com. Please like, share, subscribe, all that jazz. Please leave your comments. Would love to hear from you. Make this more interactive. This is the Capital News. I am Alex Karitis. Godspeed.